In this presentation, we will continue on with our discussion of substantive procedures related to payroll and human resources. We will start off our discussion with payroll expense accounts. It's important to note that if we're dealing with publicly traded companies, it's very likely that they're going to have a lot of different payroll expense accounts, a lot of different categorizations of the payroll expense accounts. If internal control is reliable, detailed tests of all payroll expense accounts is not needed. Additional testing is necessary only when control weakness exists. Now, what does that mean? You might think, well, that seems kind of unusual that we wouldn't be testing the payroll accounts. What we're basically saying here is that if there's a lot of different payroll type of accounts, it's really a classification of the different type of payroll classifications that we have. If we have strong internal controls in place, including a computerized system as we process the payroll, we should be able to test the controls, and it should be enough to be able to know that the classification of payroll as it's being run is classified to the proper type of expense account. What we're going to test, what we're more concerned with oftentimes, is the payroll as a whole, as a total, because we want to verify that the total payroll is being processed correctly. And therefore, one thing that we're going to have to do for sure is to take all these expense accounts, put them together typically, and consider payroll as a whole. Is payroll as a whole being reported properly, being recorded properly, and does it tie out to the different types of areas it should be reported on, including the financial statements, the tax return, including the federal income tax, the income tax return, as well as payroll tax forms, 941s, 940s, W-2s, W-3s. So forms, the types of categorizations include direct and indirect manufacturing expense, general administrative salaries, sales salaries, commissions, and payroll tax expenses. So note that if you're in a company that is more simplified, like a service type of company, then you're probably going to have less of this breakout of different type of items. A small company might just have payroll expenses, and they might have payroll tax expenses. So even if you're in a small company, you'll have to break out between payroll expenses and payroll tax expenses. And again, most people are not very aware of what should be included in payroll expenses as opposed to payroll tax expenses. Just remember that the payroll tax expenses should only include the employer portion of the payroll taxes generally. Now, if you're in a larger company, like most publicly traded companies will be, there's going to be more breakouts typically between things like at least administrative and salaries. And then if you're talking about a company that's going to be in a manufacturing process, they make things, then we have the added detail of direct and indirect manufacturing expenses. Again, once the payroll has been set up and we have the employees set up in the proper categorization and the system is set up, the controls are strong for the system to be set up, then the system should be able to allocate the payroll fairly well to the correct categories. When we consider payroll as a whole, however, we're going to have to go to all these different locations. Notice up here, we're going to be looking at something that's not even an expense account, as we would normally think of it, because it's reported in inventory to pick up the direct and indirect later for manufacturing. It's not going to be expensed until it's in the form of cost of goods sold. Then we have the general administrative, the salaries, and the commission, and then of course the payroll taxes we'll have to break out separately. So it's not too complex, the payroll, if we understand how payroll works, but a lot of times people don't fully understand how payroll works, and even the people that are working within payroll, a lot of times they just process the payroll, and the automation of the system makes it so there could be less understanding because it is automated. And also, of course, the separation of duties makes it a little bit more complex for someone to really understand all the components that are involved as a whole as well. So accrued payroll liabilities. So liabilities include payroll taxes withheld. That includes federal and state income taxes, FICA taxes. FICA taxes include Social Security and Medicare. We have medical and life insurance. So these are things that are going to be usually optional for benefit type of items, which are going to be medical benefits and insurance premiums. Pensions are going to be big. We could have things like 401k plans that would be deductible from payroll as well, and other deductions. So note that we have the mandatory deductions, of course, within payroll, those being the taxes, federal income tax, Social Security, Medicare on the federal side, and then state taxes that could be withheld. Then we have the optional items, often including things like some type of insurance that could be optional, And things like a retirement plan may be something that is going to be an option that is provided. And then note that we could have a ton of other things that could be included as things that could be withheld from people's payroll as you consider the calculation of gross pay, including things like garnishments or just about any other thing that the employee decides that they would like to withhold if the employer would accommodate that, if it would make it easier. If the employee said, I'd like you to pay my utility bill, each week directly out, and the employer said, I could do that, I'm happy to do that, then they could set up a different withholding. So note, that means that the calculation of the accruals can be somewhat complex. And it also means that they could vary from employee to employee. Obviously, when we think about taxes, the Social Security and Medicare will vary from employee to employee, but at least they're somewhat standardized. Federal income tax, every employee is going to have a different set of parameters in which the federal income tax is withheld. So that becomes a bit more complex as well. So we have things such as accrued wages and salaries that we're going to have to deal with. Now, when we consider these accruals on the accrued wages and salaries, these are types of things where you'll recall that the payroll is going to be on a different system than the year-end component. So we're not going to run payroll on a perfect accrual system oftentimes, because payroll is complex enough. We're going to put payroll on whatever system it should be. In other words, we're going to run payroll monthly, bi-monthly, semi-weekly, and typically the payroll will not be run in such a way that it's going to land at 12/31 year end, and therefore we're going to have some kind of system in place to set up the accruals for things like wages that would result in people working up until the cutoff date, the end of the year, but which have not yet been paid until sometime after that time period. We have the accrued benefits, including things like vacation and sick pay that we're going to have to consider. We've got the accrued payroll taxes. So the accrued payroll taxes are going to be those payroll taxes that have been incurred. And payroll taxes, you'll recall, are not the employee Social Security, Medicare, and federal income tax. Those are the employee, basically, payroll, which we're withholding and going to pay on their behalf necessarily. So the payroll taxes are something that we'll have to withhold from their paychecks and report that. But notice the payroll tax expense that we're considering is the employer portion. On the expense side, the payroll tax expense is what we're reporting. And then on the liability side, we'll have the accrued wages related to the employee earnings, as well as the payroll taxes. And then we'll have the accrued commissions. So any accrued commissions is something we'll have to consider. Similar kind of fashion. When was the commission earned? When will it be paid? And what type of accrual should be in place as of the cutoff date, as of the year end. Accrued bonuses as well. Note, bonuses, of course, usually only apply to basically upper management, or in some cases, or in some case of format such as that, but they can't be significant because the bonus can't be large. And it's often something that's going to be thought of kind of year-end type of planning type of information. So we want to be able to make sure that we have considered what the bonus situation is as well, and make sure we have proper accruals as of the end of the year related to them. Then we have the accrued payroll liabilities. We're going to consider cutoff. So cutoff, the year-end cutoff. An examination of supporting documentation for the accruals will provide evidence on the correct period for recording the expense or liability. So we want to basically examination of the supporting documentation. We want to make sure that if we go back and check the supporting documentation, that we have the proper cutoff. In a large type of company, in a publicly traded company, they should be doing proper accruals, and they should have been documenting the information and have that all set up. And we can basically review the documentation to make sure that the proper cutoff is indeed taking place, making sure that, the expenses that should be recorded before the end of the year, let's say 12/31, have been. The expenses that were after the end of the year are properly recorded after the end of the year. If you're talking about a small company, then they may have that difference between the adjusting entry. You might have to do more work to consider that adjusting entry, the calculation of the adjusting entry, and make sure that the adjusting entry is done well. In order to understand that better, you want to consider just financial accounting, the adjusting entry process, and that'll help you out with understanding the audit process related to payroll. And then we have assertions of existence, accuracy, and valuation. To verify, the auditor will trace the amount included on the account analysis working papers to supporting documentation like payroll tax reports. So we're going to agree the amounts on the working papers to the payroll tax reports. And of course, the payroll taxes are something that have been filed, formal documentation. We have payroll tax reports in terms of the things we can verify We have the quarterly reports, typically the 941s. And then we have the yearly report, the 940. We have the year-end documentation, the W-2s and the W-3s. And we have the federal income taxes that the employer is going to have to do their federal income taxes and will be writing off payroll in some way. So that should agree as well. So note the financial statements, we could tie all this stuff together and get some kind of verification. In other words, we can reconcile these different types of documentations. What's reported on the tax return for the federal income tax, what's recorded on the 941s, what's recorded on the 940, what's recorded on the W-2 and the W-3. Now we look at the completeness assertion. Auditor needs to understand the normal payroll-related taxes that are paid by the entity. So we need to understand the normal payroll-related taxes. That will allow the auditor to be able to determine if accruals have been made for the payroll items such as Social Security taxes and unemployment taxes. So we can go through and then get an understanding if the accruals related to Social Security and unemployment are done correctly. And then, of course, the auditor needs to be sure that all necessary financial statement disclosures for the human resources management process are done as well. We want to make sure that we consider all the basic types of accrued liabilities that could be involved within the payroll process. Those include things like the pension benefits. We want to take a sample and test the pension benefits, as well as the post-retirement benefits. And these can be complicated type of items in order to test. So we want to make sure that we have the understanding of these items, possibly specialists, in order to test these types of items. If we're talking about large publicly traded companies, these can be a bit confusing depending on the types of pension plans that are put in place. We're talking about smaller type of organizations. They may have basically more simplified types of plans that we can test and make sure they're recorded properly. We have the profit sharing plans. Again, a profit sharing plan can add some complications. We want to make sure that the profit sharing plans have been recorded properly. We have the stock-based compensation. So if there's going to be stock-based compensation, that can add a level of complication that we'd have to look into as well. And then deferred compensation arrangements. So we have some kind of deferred compensation arrangements. These could add levels of complexity as well. Notice that these are a lot of complexity, of course, will be for larger types of organizations. If we're talking about publicly traded companies, payroll can have many more of these kind of complexities. If we're talking about smaller type of companies, then they're probably using more simplified types of terms. They might provide benefits and they could provide something like health insurance. They might provide things like pension plans, but they might be doing so in a bit more simplified of a model or more standardized type of model. It could be a lot more complex in terms of the structure of things such as pension plans and retirement type plans and other types of options, include profit sharing options and stock-based compensations. These are things, of course, that you would see more relevant or be more applicable or would see more often in larger types of organizations. Then we have the audit findings and evaluation. If the likely misstatement is less than the tolerable misstatement, then the auditor may accept the accounts as fairly stated. So one more time, if the likely misstatement is less than the tolerable misstatement, so we've done the audit, we have the likely misstatement, it's less than the tolerable misstatement, the auditor may accept the accounts as fairly presented. We're going to accept the accounts typically then as fairly presented. If the likely misstatement is greater than the tolerable misstatement, however, so we've done the audit procedures, the likely misstatement is greater than the tolerable misstatement, then the auditor needs to conclude that the accounts are not fairly presented in that case.